Welcome, Market Rebels! Last week we looked at why anticipating beliefs is far more difficult than it sounds. But once traders have an idea, they often struggle to make money. It's not that they're necessarily bad at picking good stocks, they're measuring with the wrong ruler. Measuring with the wrong ruler. The Chicago Bears football field at Soldier Field is 100 yards long. The city is about 28 miles long. Since 100 is bigger than 28, the football field must be longer than the city. That means a wide receiver could score 6 points somewhere near the airport. There must be a mistake. While yards and miles are both measurements of distance, they're on different scales. The football field isn't longer, the ruler changed. Well, that's obvious, so why are we talking about it? Who could possibly make such a mindless mistake? Well, options traders make it all the time, and mindlessness is costly. Percentages are the wrong ruler. Traders spend their time chasing large returns, but they don't consider the thing they really should be chasing: dollars. Nowhere is this mistake more obvious than in how traders compare S&P 500 options, SPX, to options on high-volatility individual stocks. Retail traders chase cheap options, high volatility, and dramatic percentage gains. They look at SPX options and say, wow, those suckers are expensive. And at only 16% volatility, you'll never make any money there. But then they find options on leveragedreams.com trading for $1 and say, this could easily double. Both statements are technically true and deeply misleading. Retail traders like to compare percentage gains on option prices instead of the more meaningful dollars earned. A $1 option rising to $2 feels spectacular. It's a 100% return. A $40 option rising to $50 feels dull, as it's only 25%. But the first trade made $100, while the second made $1,000. Percentages exaggerate small trades and trivialize large ones. The reason for the misperception is that percentages don't have a scale, at least not an economic one. For instance, is $1,000 bigger than $50? Yes, and that's because dollars sit on the same scale. $0 means no value. Intervals also have meaning, so $1,000 is 20 times bigger than $50. But percentages don't work that way. Is a 100% gain bigger than a 50% gain? There's no way to tell because percentages are ratios and they can't stand alone. A 0% increase doesn't mean no value. It means no change in value. Percentages can't be ordered meaningfully as outcomes without knowing the base. You don't know if the distance changed or the ruler. Instead, to give percentages meaning, you must always ask a percent of what. You need to know the base. Without a base, there's no economic scale. A 10% gain on a $10,000 account and a 10% gain on a $1 million account are not equivalent experiences, even though the percentages suggest they are. For traders, a 100% gain feels like success no matter how small the trade. That's a trap. Percentages feel objective, scientific, and fair, yet they quietly erase the one thing markets actually care about: dollars. This is why traders celebrate doubling a cheap option while ignoring trades that quietly produce far more money. Options don't care how exciting a stock is. They care how many dollars move when you're right. Options also don't care about percentages. They settle in dollars whether traders want to admit it or not. If you call yourself a trader, you must be aware of the thing you're trading: dollars. They're easy to overlook until you understand how to measure them. This is why SPX options are routinely dismissed as too expensive, even though they often deliver more exposure, more efficiency, and more capital impact than their high volatility cousins. The reason SPX options appear expensive isn't due to their pricing. The problem is the ruler traders are using to measure it. Notional size, the forgotten measuring stick. Every option controls a certain amount of underlying exposure, which is called the notional value. But there are different types of notional values. Because options control 100 shares, a stock trading at $40 has $4,000 of total notional exposure. However, your notional exposure is the option's delta multiplied by the underlying price. It shows the economic value by revealing how many shares you're effectively controlling now. So if you own the at-the-money, ATM, $40 call, your delta is about 50. So your notional exposure is $2,000 worth of stock at that time. However, if you own an at-the-money call on the SPX, currently trading around 6,800, you have $680,000 of notional value. And with the at-the-money option, it's $340,000 of effective exposure. So what's bigger, $2,000 of exposure or $340,000? Now you can see the illusion. Same delta, same bullish outlook, same directional confidence, wildly different dollar consequences. Expensive options are often cheap. Cheap options are often expensive. Looking at your delta equivalent value exposes the trap. The delta equivalent is the better measuring stick for fair comparisons. Why retail traders gravitate to cheap, volatile stocks. Retail traders use different measuring sticks. While they may not fall for thinking Chicago's football field is longer than the city, they make the same mistake by chasing cheap options because they measure everything in percentages. Larger percentages count, all else being equal, but that's rarely true with options. For example, on December 12, 2025, IREN Limited, ticker IREN, closed at about $40. The 152-day, at-the-money, $40 call, trading at over 100% volatility, closed at $13. If we adjust for delta, you're paying $13 for $20 of notional exposure, or 65% of the value. That's a monstrous premium, even though $13 may sound small. A relatively cheap stock with a high volatility sounds like it can make a big move, and it can in percentage terms. But overall, it probably won't amount to much money. For instance, if IREN rises 50% from $40 to $60, it's a $20 gain or a 54% return on your $13 investment. But that's a net $700 you put in your pocket. A 50% increase sounds impressive, but the economic value was that the stock increased $20 or $2,000 total, of which you captured $700. The rest was paid for time, volatility, and an insurance policy in case you're wrong. Yes, $700 is $700, but think about the risk you took to get it. It could have easily turned into a $1,300 loss. These are psychologically satisfying but mathematically hostile trades. Why? The expiration break-even price is the $40 strike plus the $13 premium, or $53. So if the stock is $53 or below at expiration, this option loses 100% of its value. The stock must rise 33% at expiration just to break even. Assuming the 100% implied volatility remains stable, there's only a 25% chance for this stock to rise above the $53 break-even price and a 19% chance to rise above $60 at expiration. It's probably doomed from the start, even though paying $13 to control a high volatility stock sounded like a great deal. Now compare IREN to the SPX, which closed on that same day at 6,827. The closest expiration was 151 days compared to 152 days for IREN, and the at-the-money 6,825 call closed at $336. That sounds expensive in dollar terms, especially compared to the $13 premium for iron. However, they look expensive because they're insuring an expensive underlying. Remember, options are insurance policies, and just as you'll pay more to insure a Ferrari than a Volkswagen, you'll pay more for expensive stocks. How much more is the SPX? The notional value for SPX is about $683,000. That's 170 times larger than iron. That's why SPX premiums appear large. Because this is an at-the-money option, the 50 delta makes your delta exposure half that, or about $342,000. So the $336 option premium is only about 10% of the effective position size, much less than the 65% premium for iron when put on the same scale. Contrary to what most traders think, SPX options are relatively cheap. Who would have guessed by comparing a $13 option to one valued at $336? When traders say SPX options are expensive, they're really saying they're uncomfortable paying for a very large amount of exposure. But exposure is the entire point of trading options. A cheap option on a volatile stock is often cheap for a reason. The distribution is wide and unforgiving. SPX volatility, by contrast, is aggregated and diversified. Single stock blowups disappear inside the index. Okay, SPX may be relatively cheaper, but how will its performance compare considering that indexes usually don't make big moves over 151 days? It certainly won't double in that time like iron could. Okay, good point. It would be unfair to use the 50% return we use for iron for the SPX. But what if we use something smaller, say a 5% return? If the SPX rises 5% at expiration, it's a $34,000 gain. Quite a difference from the $700 gain you got from a 50% return on iron. Further, there's about a 45% chance for SPX to gain 5% over that time. It's much more likely to happen. So, would you rather have a stock that needs an unlikely 50% return to generate $700? Or the index that needs a highly probable 5% return to yield $34,000? While a 5% return won't get you many likes on Facebook, hopefully $34,000 will. SPX options don't offer lottery fantasies. They don't flatter egos with percentages, but they do offer tremendous capital efficiency. It may be boring until you realize that's where dollars live. Institutions don't think about percentages, neither should you. Still, options traders constantly say things like, "This option can triple, it's only 20 cents, and the implied volatility is huge." But if you want to make real money with options, the real questions are always, triple from what, on how much notional value, and with what probability. A small premium can triple and still be meaningless. After all, 3 multiplied by nearly nothing is, well, nearly nothing. The big misconception is when traders think high volatility means big opportunity. High implied volatility only means something might happen. A high price level determines how much you get paid when it does. Instead, high dollar exposure per unit of probability means a big opportunity. In other words, for every $1 move in the underlying, how much money is waiting? Traders often have lackluster performance not because they chose the wrong direction, but because they chose the wrong ruler. Cheap, high volatility stocks look exciting because they're measured in inches. SPX options look expensive because they're measured in miles. But distance is distance, exposure is exposure, and risk is risk. Once everything is measured on the same scale, dollars per unit of uncertainty, the illusion disappears. The market didn't change, the ruler did. And until traders stop switching rulers mid-sentence, they'll keep mistaking small numbers for big opportunities and big numbers for big risks. Markets don't lie, rulers do. Next week, find out why risk is never eliminated, only moved. If you're hedging positions, you're not reducing risk, only changing where it appears. Risk mitigation is simply risk migration. If you're not sure where that risk moved, you'll end up with unwanted surprises, and those can be the most expensive of all.